The following is a presentation of TFNN.
Good evening, everyone, from Los Angeles, California, specifically Sherman Oaks. My name is Ken Shreve. I write the Ultimate Growth Stocks newsletter, and I host Breakout Investing with Ken Shreve every Tuesday and Thursday on TFNN from 3 to 4 p.m. Eastern. I can't believe it. My first webinar with Tom O'Brien and TFNN. I'm sure I'll be doing many more in coming months, but the purpose of tonight's webinar is really just to introduce myself to you. I know that probably a lot of you listen to my radio show, Breakout Investing with Ken Shreve, again, every Tuesday and Thursday from 3 to 4 p.m. Eastern, but I wanted to just do a webinar. We're going to go about just 30 minutes of information. I'm going to go over some former holdings that I've had in my Ultimate Growth Stocks model portfolio, and specifically, just talk about how I evaluate a stock, what goes into my decision to buy a stock. And I can tell you right from the onset, I use fundamental and technical analysis to evaluate a stock, but I'm not going to find a good chart and make a buy just because of a bullish technical picture. I need to make sure that there's a fundamental story that is fueling the bullish chart. So if the strong technicals are there but the fundamentals aren't there, I'm not interested. And I know that there are investors out there that are fundamental investors alone. They would be kind of bottoms-up investors. They don't pay attention to the general market. They just, they find a cheap stock, they buy it, they hold it for 5 or 10 years. But I use fundamental and technical analysis, and I'll get a little more into my methodology as we go on. But there are really 3, key fundamental factors that I look for. But again, just a little bit about my newsletter. I started publishing about 3 months ago at TFNN.com. My background quickly is I really learned how to invest during my 12 years at Investors Business Daily. I started there in the mid-1990s, started to learn quickly from Bill O'Neill, his portfolio managers there, did a lot of workshops and seminars, and really kind of turned into a spokesman for the company during my past 5-6 years there. About a year and a half ago, I went over to the street. Jim Cramer asked me to come over to the street, so I did, and I still write and do commentary for the street, and I do still work there, but very happy to have launched my newsletter with TFNN in late April. Quick word about the market today. I just wanted to just touch on the fact that it was, we finally saw some volume in the market today. I think, we ended up probably having a 2.4, maybe 2.5 billion share day on the NASDAQ. Take a quick look and just see where we ended volume-wise, but there was good volume in the NASDAQ today. Finally, it was above average. We had, it looks like 2.36 billion shares on the NASDAQ, so a little conviction behind the buying today. And now the NASDAQ is only about 45 points from its recent high, or a swing point of 2878. The S&P 500 only about 13 points from its recent high of 1356. So you just get the feeling that there's going to be a headline that comes out of Washington sooner rather than later, certainly before this August 2nd debt ceiling deadline, and that it could be the fuel necessary to power a breakout for this market. Now, breakout's going to have a hard time making headway if we don't have any volume. If we go through this swing point on, NASDAQ volume is, 1.7 billion shares, that's not going to be compelling. I'm really, still waiting for bona fide institutional money to come in from the sidelines. Really haven't seen it yet, but, again, good gains for the market today. We did see some a pretty good volume behind the moves. My general take on things, I wouldn't be surprised to see a scenario similar to last year around this time play out this year as well, where we see some optimism about earnings. We may see a little more strength in the market, and we could see some softness in the month of August, and that hopefully will set up just like it did last year, late August, early September, where we started to see institutional money come into the market that eventually powered, I think it was a 25-30% gain for the NASDAQ in a relatively short amount of time. So I wouldn't be surprised to see a scenario like that play out this year as well. Basically, what I bring to the table as a newsletter writer is an extremely disciplined approach in terms of buying growth stocks. I invest in sometimes stocks that have high multiples. I'm certainly not afraid to admit when I'm wrong, which makes me different than a lot of other newsletter writers. I do not average down in price, and I really started to see meaningful returns in the market the more and more comfortable I felt, cutting a stock loose. And that sounds a bit counterintuitive, might not make sense, but taking a small loss in a stock as opposed to seeing a big loss just get bigger and bigger, I mean, that's just a big confidence buster, and it can really do devastating damage to a portfolio. So if I'm wrong on a stock in my model portfolio, I'm very clear on how I explain that to people. To subscribers, that if I'm wrong, I'm going to just move on, and I'm not going to worry about it. I'm not going to watch the stock for the next 2-3 weeks, and if it starts going up, start pounding the table saying, why did I sell? Why did I sell? The market's going to tell me if I'm right or wrong in a stock, and that's usually pretty easy to tell what that message is. All right, I talked about, let's get into some of the meat and bones of this webinar. I talked about there are 3 things outside of technicals, not paying attention to technical analysis at all. I look at 3 things when I'm evaluating a stock. And by the way, I should mention that during my time at Investors Business Daily, and I know Tom still has people from IBD come on his show, and he's been associated with them for a long time. But the screens in that paper really do an outstanding job of presenting fundamentally strong companies. Now, sometimes you're going to see some small, thin stocks in the screens, market caps of 300, 400 million, maybe average daily volumes of 100,000, 200,000 shares. But by and large, the majority of stocks that you see in their growth screens, whether it's the IBD 50, your weekly review, the stock spotlight, you're getting fundamentally strong stocks. Technically, they might not all be healthy, but they're fundamentally strong. They have a common trait, and that is good earnings and sales growth in recent quarters. And that's what really one of the main things I look at. I want to see minimum quarterly earnings growth of 25% or more, generally speaking. In many cases, I'm going to have stocks that are showing year-over-year growth of 50%, 75%, 100% or more. So strong bottom line and top line growth is very important to me. And, that's just telling me that the company is firing on all cylinders, because you have to remember, earnings and sales growth is what ultimately fuels a stock's price performance. Earnings and sales growth is what ultimately fuels a stock's price performance. If earnings are expanding, you're typically going to get multiple expansion. A stock doesn't, go to a 50% gain, to a 100% gain, to a 300% gain, to a 400% gain with contracting earnings and decreasing market share. Okay, the stock price is growing because their earnings are expanding, their revenue is expanding, and their market share is expanding. Okay, so that's a common trait among stocks in my model portfolio now, and that will continue to be for as long as I write this newsletter. Strong growth matters to me. The other thing I never underestimate is return on equity. Okay, so I want to see strong earnings and sales growth in recent quarters, and I also want to see strong return on equity. Generally speaking, return on equity is going to be in the 20% area. I have some holdings in my portfolio now where return on equity is 30%, 40%. Okay, but 20% is a general number. If I find a company that looks good on a lot of different levels, strong chart, looks like it's poised to break out, being accumulated by institutions, and return on equity is 15%, sometimes I'll give it a little leeway to that. The final thing that I want to talk about is mutual fund sponsorship. This is also very important for a stock's price performance. So not only do earnings and sales growth fuel a stock's price performance, but you have to have institutional sponsorship, mutual fund managers, banks, pension funds, big buyers that are buying the stock. They're the ones that are the most responsible for influencing a stock's price. mean, when you and I buy 200 shares of a stock or 300 shares of a stock, that's not going to do much to move the price. But when a big 10,000 share, 20,000 share buy order comes in, that's what moves price. So you want to pay attention to mutual fund sponsorship. You can find sponsorship data in Investors Business Daily, mutual fund ownership data. You can also find it at Yahoo Finance. Typically, I like to target stocks. I mean, liquidity is important to me. So I have, general benchmarks. I generally am not going to look at stocks with market caps of less than 1 billion. There may be an exception here or there, but I like liquidity as well. So I like to see an average daily volume, generally speaking, around 500,000. There's always going to be an exception here and there. And I like to target liquid stocks because institutions, the main driving force in the market, they're not going to be looking at stocks very often that trade, 50,000, 100,000 shares a day. Okay, so those are the three things that really matter to me a lot. Strong earnings and sales growth in recent quarters. The single-digit earners, for example, in the Dow, great companies with great balance sheets. But when I see year-over-year earnings growth of 5%, sales growth of 3%, just doesn't interest me. These companies are past their best stages of growth. Okay, so focusing on newer companies, maybe companies that are 5, 10, 15, 20 years old, that's where you tend to see the strongest earnings growth, and that's another common trait of stocks in my model portfolio currently. They're not old dinosaur companies that are past their best years of growth. All right, I want to take a look at I think 4 or 5 stocks that I've held recently in my model portfolio, and the first stock we're going to take a look at is Decker's Outdoor. I have a chart of invertible up here right now, but let's go to Decker's Outdoor. You can see I put a little graphic up here. Decker's Outdoor is a stock that I bought in October of last year, October 12th specifically, and I sold it on December 22nd for a 62% gain in my Ultimate Growth Stocks model portfolio. You can see where I bought the stock. It was coming out of a nice consolidation right here, and then I rode it higher again for a little over 2 months and made the decision to sell. It got soft after that and then continued to move higher, but at the time, earnings were up 24% year over year. Sales up 22% from the year-ago quarter. Return on equity was 28%. 541 mutual funds had a position in the stock. In the quarter before that, earnings growth at Decker's was 156%. Compared to the year-ago quarter. Sales were up 34% compared to the year-ago quarter. So this is still a very interesting company in this market. You can see its recent consolidation. If this market heads higher, this is a stock that I'm not going to give up yet. I don't own it in the model portfolio. There are several stocks that I'm watching. But we're in earnings season right now, and taking fresh, brand new positions ahead of growth names like this, a couple of days ahead of an earnings report is generally pretty risky. So I'm going to be doing more watching at this point. But opportunities may present themselves. But Decker's was a very good buy for me last year. Again, bought on October 12th, sold on December 22nd for a 62% gain. And eventually I'm going to do a technical analysis seminar and kind of teach you how to evaluate price and volume trends in a chart. But the buy here was when Decker's was coming out of a nice base. It was running higher. It took a little breathing period, built a base, made a nice foundation, and then broke out. So it was really just an optimum time to buy it. And that's the thing. When you're buying fast-growing companies like this in the right time of market, remember I talked about when did the market get strong last year? The market got strong last year right around the time this was happening. This was in late August, early September, when Decker's and a slew of other stocks broke out. And, you can see that the gains that you can make in companies with good earnings and sales growth in recent quarters. All right, also want to take a look at a name that some of you may not be familiar with, Tenneco Automotive. That's ticker TEN. And Tenneco Automotive is, it's an interesting company. Currently has a market cap of 2.6. So it's kind of small, mid-cap in nature. It manufactures automotive emission ride control products for OEMs and aftermarket. But this is another stock that I bought, again, right around the same time as Decker's Outdoor. It broke out from a nice base right around this area here. Tenneco I bought on August 17th, just before stocks bottomed last year. Sold it on December 7th for a 51% gain for the model portfolio. And you can see it's been kind of flatlining since then. Technically, still holding up, but this stock started looking a little bit tired to me up here. Bottom line, the right time to buy it was right around the time I did last year. Earnings at the time up 457% from a year ago. Sales up 23%. Return on equity 25%. Number of funds owning the stock 395. So Tenneco was a good sell for me last year. Move on and take a look at Cognizant Technology Solutions. It's actually a pretty big company that continues to grow pretty fast. Take a look at Cognizant. And you can see at the time I bought Cognizant. This was a little bit earlier in the year of 2010. Cognizant I bought July 12th. Sold it a little more than right around 6 months later, actually, for a 39% gain. But you can see the sells. You hear people say you're never going to sell right at the top, and I agree with that. I mean, if I buy a stock and fortunate enough to get a good gain in it, and the market is right, and there's institutional money coming into the market, and the tide is flowing positive, I want to ride that stock for as long as possible. But stocks always give you clues when they're starting to get tired, and those clues always come by price and volume. Otherwise, there's going to be a time when institutions start to unload the stock. They think the stock has made a big run, and you look at a weekly chart of Cognizant, you can see it's been a tremendous price performer over the past 2-3 years. And now, similar to Tenneco, it looks like a stock that's starting to get a little bit tired. You can see it's trading right around its key moving averages. I mean, in a situation like this, I use the 10-week moving average and the 40-week moving average on a weekly chart. Healthy stocks that are showing strong relative price strength in the market, are always going to have the 10-week line trending well above the 40-week line. That's just showing you that the stock is performing well in the market price-wise. You can see how Cognizant is starting to tire out here. The 10-week moving average is starting to cross with the 40-day. It's really looking long in the tooth here, but nonetheless, last year this was a good trade for my Ultimate Growth Stocks model portfolio. Let's move on and take a look at a stock that I actually mishandled. I mean, I took a pretty nice gain in it, but boy, did I leave a lot on the table. But I've been doing this a long time, and I'm sure many of you have as well. And even though it's frustrating to leave a lot of money on the table, you make a sell decision based on the information that you have available at the time. That's the bottom line. And sometimes you're gonna cut a loss in a stock at 3, 4, 5%, and right when you sell it is going to be the bottom of the stock, and then it's going to go up 10, 20% over the next month or two. Again, I'm comfortable. I always, when I sell a stock, I'm always comfortable with why I sold it, and I never look back. That's the worst thing that you can do, because then you just get frustrated. Then your emotions get involved, and you start to get mad at the market, and yada yada yada. I mean, listen, nothing wrong with taking a profit. Now, Lulu, I made a mistake with this one because I bought it right in November of last year. Market had been rallying for a while, and I sold it 2 months later for a 35.5% gain. And it was a bad sell. I mean, it was a sell where I was able to book a nice gain, but you can see, I mean, I sold it. I'm not even looking at it now. I'm not even sure why I did, because it was holding above. It had just started to consolidate. It just firmed up right at its 10-week moving average here, and then it just kind of kept moving higher and higher. Now, Lululemon split 2 for 1. So this is You can see here I bought it, again, it was a 35% gain in about 2 months' time, but it was definitely a sell that was too early. And, again, I can be self-effacing sometimes as a newsletter writer. We're not perfect, and, not every stock I recommend to buy is not going to go up, and I'm going to put a sell alert out there at some point, and hey, the stock may keep going higher, but I'm confident enough. The bottom line is that I'm confident enough in the methodology. I've been doing it for long enough. I've been through different markets, and I'm comfortable with my buy and sell discipline. It's not going to be perfect all the time, and Lululemon was an early sell, but still a 2-month gain over a short amount of time. All right, final stock I want to take a look at is Network Appliance. Network Appliance, ticker NTAP. This is a company at the time. Earnings were up 46% from a year ago. Sales up 33%. Return on equity 28%. A lot of funds in this. And I haven't talked about stocks being over-owned eventually, but that 1600 level is starting to get to a point where it's possible that a stock can get over-owned by by mutual fund managers. In other words, there are so many funds in it that it becomes difficult to move the share price. And this didn't turn out to be the case with Network Appliance, but it brings up a good point that, by and large, if I can find a good growth company that maybe is only 10, 15 years old, still in the early stages of its business, and there might be 200, 300 mutual funds that own the stock, that's really the best of both worlds. Not only is there's plenty of room for more funds to come in and discover it in coming years, but you're also looking at a stock that has good earnings and sales growth, good return on equity. But it's good to get them in the early stages of a move rather than the later stages. You can see Network Appliance right now, another stock that's looking does not look like a leadership stock anymore. Okay, it looks to me like it's breaking down, frankly. Now, when I got it last year, NetApp was bought on June 2nd. I sold it for a 39% gain in mid-December, up around here, and went higher for a few more weeks, but now is really starting to flail around, having problems at its moving averages. Another stock that just looks tired to me. So those are some of the former holdings in my model portfolio. And maybe I should do a webinar at some point coming up. Talk about mistakes sometimes that newsletter writers make, because not all of my buys are going to go up, and I fully admit that. And I think most of you are savvy enough to know that you're never going to you pick 20 stocks, not all 20 are going to turn into winners. So you have to know how to handle them. There's still a lot of buy and hold investors out there, and my goal when I buy a stock is to hold it for a long time. I want to buy it as it's coming out of a base, and I want to be able to hold it for a long time. I had an opportunity to do that with Lululemon, and I sold too quickly. I took a 35% gain in 2 months' time. But that's the goal. The goal is to be a long-term investor. But if the market tells you that you're wrong at any point, whether it's a week after you bought the stock or whatever, you have to listen to the market's message. I learned very early on that arguing with the market is generally a losing proposition. Other names recently this year, Green Mountain Coffee Roasters. I think actually I can pull up a chart of Green Mountain. I might have marked one up there. It's been kind of a trader's market. Again, I'm not a day trader, and my goal isn't to buy in the morning, sell in the afternoon. I mean, I want to kind of build a portfolio here, but you have to adapt to market conditions. And Green Mountain Coffee Roasters is a stock that I just bought last month in June, and I bought it as it was coming out of this consolidation right here. And I think I held this for about 2 weeks because I just was I thought the market was skittish. I thought that it could turn at any time, and you can see I sold it for several points higher, but this was a short-term trade for me. Frankly, Green Mountain Coffee Roasters continues to hold up very well, and they're going to be coming out with with earnings next week, as a matter of fact. And, technically it looks healthy, but, I mean, you got to think it's a stock that has just made such a move. I'm certainly not thinking about taking a new position in this stock so close to earnings. That seems silly. Will they report a strong quarter? I think they will. But how the market is going to react is anybody's guess, and it just seems like kind of spinning the roulette wheel at this point. Our earnings are expected to be up 95% to 37 cents a share. Sales up 95% to $608.4 million. So, Green Mountain fundamentally has a lot of characteristics that I like to see. I mean, their fourth quarter profit up 129%. Sales up 101%. You can see the data here. And Fossil was another one. Take a look at Fossil here. And Fossil was another kind of short-term trade. I bought it again last month, held it for maybe a week or two, and I just said it's getting more and more and more extended. Obviously, a sell that was too early, but I took several points in it, and this is another one. Obviously, sold it too early. It just doesn't want to go down. Do you buy it up here? Absolutely not. Super extended in price, overbought, whatever term you want to use. I just think the risk outweighs the reward. Let this one come in, form a base, and then you could get another opportunity to buy it. Okay, so that's the last thing I wanted to talk about, and I don't have a mocked up chart for it, but I wanted to take a look at Acme Packet because they reported earnings after the close today. I've never owned this stock, but it is a fast-growing company, and there comes a point. A lot of people are going to be talking about how strong the earnings growth at Acme Packet is. And there's no doubt that in recent quarters, the growth is there. And in the current quarter, I didn't look at the numbers specifically after the close today, but this is a stock that has been obviously bleeding badly. Technically, it's breaking down. It fell below its 200-day moving average today. And here you're looking at a company that grew the top line by 49%. Year over year to close to $80 million in sales. Their bottom line grew 53%. Bottom line is that fundamentals can sometimes look the best near a top, which is also counterintuitive. And I don't know if that's going to end up being the case with a Green Mountain, a Netflix, a Fossil. But the bottom line is there are a lot of stocks out there that have been that are up 200, 300, 400% since this bull market started in March 2009, and a lot of them are continuing, to deliver that strong bottom line and top line growth. But you have to remember they've run up a lot, and a stock's run is eventually going to come to an end. If you're familiar with some of IBD's teachings, you see a lot of late stage bases out there. Stock that formed a base, it broke out, it ran up in price, it formed another base, broke out, ran up in price, formed another base, broke out, ran up in price. So you get these series of breakouts. And late stage bases, they can take 2-3 years to play out. But look at a weekly chart of Acme Packet here. Let's take a look at a weekly chart. You can see how far this stock has come. A breakout here in $10 a share runs up to 65. I mean, there's a lot of big price move here. Good growth after the close today, but looks like a stock that is breaking down. Okay, we do have some fast growers coming up with earnings next week. I'll listen closely to what these companies have to say, but again, not really interested in taking positions at this point. Netflix coming out with earnings next week. Profit is expected to rise 39% to $1.11 a share. We take a quick look at Netflix. This is another stock that has just made a monster move in a short amount of time. I made a quick trade in Netflix just recently. Took several points in profit, but did not hold it very long. Sales up 52% to $790.5 million. And Goldcore is another interesting company. They're reporting earnings next week. Take a look at Goldcore. And Goldcore actually is looking technically pretty healthy. Stock underperformed today, down about 2% to 53.13, but they're expected to grow profit 93% to 52 cents a share. Sales up 64% to 1.4 billion. So, bottom line, all the stocks that we just looked at, they all have the characteristics that I like to see. Strong bottom line, top line growth in recent quarters. I talked about Acme Packet not as a good stock, but just as an example of how fundamentals can look the best at or near a stock's top. But strong earnings and sales growth in recent quarters. You want to see high return on equity, and you also want to see sponsorship. Okay, you want to make sure that there are fund managers in that stock, because if a stock has sponsorship, that is really another piece of the puzzle for a stock to enjoy pretty big price gains. All right, we're about to head into the Q&A session, and I'm going to just remind you about stocks. You can get a 2-week trial. There is a introductory rate that's been going on for a few months now. It's going to end at the end of July. So you can get a 2-week trial, no obligation at all, but you can take advantage of the $395 annual price before the end of July, because the price is going up effective August 1st. You can get an idea of my methodology, but I think it'd be well worth your time. I enjoy writing very much. I spend a lot of time with the newsletter. Again, I publish every Tuesday, and I send out buy and sell alerts in between when appropriate. Some weeks are busier than others, but I have been initiating some new positions recently, but being very cautious during earnings season, because again, taking a new position in a stock so close to earnings is risky business. But in terms of overall portfolio strategy, I talked about some of the things that I like to see in a stock: earnings growth, fund sponsorship, return on equity. I also like to target strong price performers. If that wasn't obvious to you when I was showing you some of these examples, I like to target the leading price performers in an industry group. Technical analysis plays a major role in my buying decision, but again, I'm not going to look at a bullish chart unless there's a fundamental story in place. I'm just not looking for stocks going up in price. There has to be a fundamental story driving growth. I'm also not afraid to target high multiple stocks. I always know what a stock's PE ratio is. It's trailing PE, it's forward PE. If it's selling at 40 times trailing earnings and 50 times forward earnings, yet it's growing 75, 100% annually, to me that still could be a cheap stock, especially if the fundamentals are there and the chart is there. So my model portfolio is not filled with high multiple stocks, but I definitely have some high multiple names in there because they are growing earnings rapidly. Of course, I don't chase stocks. That's a common mistake among growth investors, especially when you're new at this. Buying breakouts, buying strong price performers. Sometimes you buy a stock too late. So try to provide some education in my newsletter. Maybe put an example of an extended stock, saying, this is not a stock you want to be buying. I mentioned Fossil that we just talked about. Very, very extended right now. You just can't buy it with a clear mind all the way up here where it's currently at. It hasn't consolidated at all. So you want to avoid buying extended stocks. I rarely average down in price. In fact, I average up. If I buy a stock and it works, I look for an additional opportunity to fill out the position. And when I do that, if I buy 400 shares initially, I'm not going to go top heavy with that second buy and buy another 600 shares. If I buy 400 to start, I'm going to buy 150, 200. That keeps my average cost in check. Generally not going to let a stock get to be more than 6-7%, maybe 8% of the total portfolio. But I have 8 stocks in there right now, so I scale into positions. I don't overcommit to a stock on the initial purchase. I want to nibble, see if it works. I will generally know in a week or two if it's going to work. And if the market tells me it's not working, I will, and it starts to go lower, doesn't do what I expect it to do, I'm not afraid to cut losses, especially if it's a higher beta aggressive growth name. So that's pretty much where we're at. The price of Ultimate Growth Stocks is going up at the end of this month. You can take advantage of the introductory rate between now and July 31st. There's a 2-week trial, no obligation, and I hope you'll check it out and see what I'm all about. So I'm going to turn the camera off, and then we can take some questions for the next 25 minutes or so, or however long it's lasts. I don't know how many questions are in there, but why don't we go ahead and do that. Okay, question about trading on weekly signals or daily or shorter term. I mean, that's you really have to adapt to the market environment. We've been in a kind of a low volume time in the market for several months now, and that's what has kind of made me more shorter term than I usually am. I mean, when I was buying stocks for my model portfolio in late August, early September last year, I was not short term at that point. Now I did, I sold Lulu again two months later, but you got a good buy signal in the market on September 1st, 2010. That's really a time where you can buy stocks that are breaking out of bases, and you can hold on to them for a period of time. So, in this type of market right now, where there's still some uncertainty, I mean, it looks like the market could try to break out here. I'm just not convinced that there's enough money coming in from the sidelines, institutional money. I'm not convinced that there's enough in the market right now that's going to be able to fuel a meaningful breakout. If I continue to see volume trends improve in the market, then I can move from kind of a shorter term approach to, feeling more comfortable that when I buy a stock, I'm going to be able to hold it for a period of time. Okay, another question: how do you handle a stock that breaks above a handle per IBD's methodology, but then comes back down and closes below the breakout point the same day? Okay, well, in that case, if you get a breakout and you buy that breakout, and then the stock, closes below the breakout point or even below the buy point, it's not necessarily the end of the world. Now, I remember there was I bought VMware several weeks ago on a breakout day, and the stock reversed in spectacular fashion. This was several weeks ago, and I mean, it was just obviously hugely disappointing action on a breakout day. I sold the stock on that day. I bought it in the morning. I was quickly down about 4%, something like that. The bottom line is I knew that it was just extraordinarily ugly price action on a breakout day. I didn't have any interest in owning the stock anymore at that point, because I know that's not what is supposed to happen. But in regard to this question, how do you handle a stock that breaks above a handle? So it breaks out successfully, but then comes back down and closes below the breakout point. I mean, first, a price action like that is telling you that you're in a market that's probably not that healthy, where your breakout success rates are going to be 50% at best. I would say that if that type of price action occurs and the stock closes 1% or 2% below your buy point, give it, see what it does the next day. But the bottom line is just is to protect your capital. I will cut losses sometimes 3 to 4% below a purchase price. Sometimes I'll give it a little more room, 7, 8, 9%. It really depends on the stock. In a case like VMware, where I got shaken out on that reversal several weeks ago, I think I ended up cutting my loss at about 3 or 4% because I just knew the price action was just rotten on that day. Okay, are you basically a short-term trader? In this type of market, again, I'm kind of adapting at this point. My goal is to buy a stock and hold it for a long time. But during times of market volatility, the bottom line is you just have to adapt to the market. So right now, definitely, I'm more a shorter term trader than I'd like to be. again, back last year, August, September, when we got a good strong follow through on September 1st, I was holding stocks for a longer period of time. If I buy a stock and if it goes up 20%, and I have a 20% gain, and it's 3 months down the line, I may decide to hold that for 3 months, sell it for a 20% profit, raise some cash, and look for new areas to put that to work. But I can say in general that my goal is to buy a stock and hold it, hold it for a long time. Market volatility, sometimes you have to adapt a little more. Do I short stocks? I do not. I do not short stocks in the model portfolio. I remember Bill O'Neill wrote a book on short selling with Gil Morales. And it was a pretty good book on shorting, and I do feel pretty comfortable. I can tell when a stock is breaking down and looks like it's about to head lower. That's why when I decide to sell a stock for the model portfolio, it generally be when I'm seeing signs of institutional selling in the stock. I'm seeing signs that big investors are taking profits, but I don't short. I don't short individual stocks. It's really hard enough, buying stocks at the right time and making money. I mean, this is a learning process. I'm still learning things 15 years after doing it. All right, question about money management. Well, I mean, that's a pretty loaded question, but again, if I have a 20% gain in a stock and I've held it for 3 or 4 months, I'm not afraid to take a profit there. I mentioned at the end, when I first decide to buy a stock, okay, I don't put everything that I want to invest in it in all at once. Okay, I start generally with a 50%, maybe a 40-50% position. So I try a little bit on for size, and then I see if it works. If it works, then I can fill out the position later in the portfolio. I've done that with some current holdings in recent weeks. I've added 2 positions that I've had for a little while. So I start small. If the stock works, I will add a little more. And I never add more than what I initially bought. So if I buy, 300 shares to start, I may add 100 at an add-on area. Maybe it pulls back in light volume. If I buy 500 shares of a stock, I might add a couple hundred shares when it's 5-6% higher in price. And that's a way I can kind of increase the weighting in the portfolio and also keep my average cost in check. So that's generally it on money management. And I'm not afraid to take profits in a stock. I want to hold on to big winners, but if I buy a stock and I have a 10% gain and I start to see distribution, professional selling, heavy volume declines in the market, there'll be times where I take a 10% I take a 10% gain. So it's we all know it's been a tough market in recent months. There's been no volume. There's been a lot of whipsaw back and forth action. It's it's a tough market to navigate. But I do follow a set of rules, and rules are very helpful in this type of environment. Okay. The examples that I used, I went over 5 stocks earlier in the webinar: DEC, Tenneco, Cognizant. Normally my decision to sell a stock, what went into my decision to sell the stocks at the time? Normally, again, it's if it's been running up in price and I see a higher volume decline, I won't necessarily sell all of it. But I may sell half of a position. But my decision to sell a stock is normally when price and volume trends start to turn negative in the stock, and that when price and volume trends start to turn negative, that is usually a result of institutional selling. So in the examples of DEC, Tenneco, Cognizant, Network Appliance, Lululemon, in some of these cases, there may not have been even signs of institutional selling. It may have just been more of a feel decision on my part, where I saw something else moving in the market. I didn't want to get greedy, and I took a gain in network appliance and put the money elsewhere. But my decision to sell a stock is generally going to be made when a support level is violated, like the 50-day moving average, especially in heavy volume. Even this year, my decision to sell, Green Mountain Coffee Roasters, Fossil, Netflix, they kept moving higher, but volume was just so light. I didn't really feel like there was any conviction behind the buying. So there, I decided, just to take several points of profit. It was kind of a short-term stay with the three stocks, but I also knew I was buying those stocks in possibly the later stages of a price move. So that's the basic answer to how I decide when to sell. I do fundamental and technical analysis helps me buy a stock, and I use technical analysis alone to help me sell. What kind of market cap do you look for at the buy point? What kind of market cap do you look for at the buy point? Well, the market cap wise, I generally am going to keep it at 1 billion or higher. There may be an example where I'm looking at a 750 million market cap company. If there's good institutional sponsorship, if it's a liquid enough stock, I may go a little bit below 1 billion, but that is typically my benchmark. I have some big cap stocks in my model portfolio right now. I've got some mid cap, and I've got some small caps in there as well. Okay. If you had to guess at what your average hold time is for each trade, what would it be? I must hold on to a trade for 90 days, firm rule. So I want to know that the majority of your trades are at least that long. Well, again, I've had some trades earlier this year that were 2 or 3 weeks in duration. So I can't say that my average holding period is 90 days. Not in a market that where losses can get out of control pretty quickly. I buy. I tend to focus on growth and aggressive growth. And if I have a high multiple name, like a Green Mountain, a Netflix, whatever it is, if I buy the stock and it starts to head lower, I'm not going to have I can't have a 90-day rule and watch a 5% loss potentially turn into a 25% loss. So. That's generally how I would answer that question. When a new round of institutional money comes into this market, and I suspect it will, between now and the end of the year, and who knows, we could start to see it sooner than people expect. But my general take on things is that we could see a little more strength in the market. We could see some softness in August, and then we could set up for a nice end-of-year move again. But at that time, when I'm convinced that institutions are coming back into this market in earnest, that's when my holding periods are going to be longer. Simple as that. Please explain how your model portfolio works. How much cash of a percent basis? I think my portfolio right now is about is only about 50% invested. At its peak, it was maybe 70% invested. I don't really think I'll ever be more than 75% invested, because I always want to keep some cash on hand. But that's where I'm at right now, about 50% invested. I think my biggest portfolio position is about 4.5-5% right now. And again, we're in earnings season right now, so I've got current holdings that are going to be reporting in coming days. Because I launched this portfolio, a lot of my holdings, I've had them since June. I mean, I didn't do a whole lot of buying in May. In fact, I was taking a lot of profits, taking money off the table. I think my cash position got to about 70% during the month of May. Generally speaking, and then I started slowly nibbling here and there in June, but I'm back up to about 45-50% invested right now. So, okay, another money management question: how much of your portfolio do you commit to a stock? Again, I would never see a holding get to be more than probably 7 to 8%. I've got some names right now. My largest allocations are only about 4.5%, maybe 5% right now. But these are stocks that are working, and if they continue to work, I could see those positions eventually getting to be 7-8% of the model portfolio. I have 11 stocks currently in my model portfolio. I don't think I've ever owned more than 15 or 16 stocks, something like that, but I have 11 in there right now, and not in a rush to go out and blindly buy things again. Especially if a company is set to report, soon. I just think the risk outweighs the reward. So currently have 11 stocks in the model portfolio. Then a question: what is a sign of institutional buying and selling? Simply put, it's really just when volume starts to expand significantly to the upside or downside. For example, if a stock breaks out in heavy volume, maybe it trades 1 million shares a day, and then it's in a nice base, it's in a nice consolidation, and then it breaks out in heavy volume. Average daily volume is 1 million shares. All of a sudden, it trades 3.4 million shares. That is institutional buying. I don't care if it's an insurance company, a pension fund, a mutual fund manager. There are people in there big that are buying. Okay, those are 20,000 share, 50,000 share blocks going through that are causing that volume to expand like that. And so I really just gauge supply and demand like that in a chart. I look for volume expansion on the upside, volume contraction on the downside. And again, if I have current holdings where I'm starting to see volume expand on the downside, especially after a lengthy run-up, I call that institutional selling. And it doesn't matter to me which fund is selling or which pension fund is selling. I know that there's selling pressure building in the stock, and it could often lead to more. So volume simply tells me what the big boys are doing in a stock. Would you consider your system a trend following system? Absolutely, positively, I would. In fact, I call myself a top-down investor. And there aren't a whole lot of top-down investors left these days. I mean, there's still a lot of bottoms-up people that don't pay any attention to the general market. But I do most of my buying when I feel that the market is on an uptrend, and the market is still in an uptrend right now. But I'm seeing some shaky action, let's call it, in several growth names I follow. And by shaky action, I'm talking about breakouts that aren't making meaningful headway. They're facing selling pressure soon after they try to break out. So I do pay a lot of attention to trends. I pay a lot of attention to price and volume in the major averages. Simply put, I focus my buys during market uptrends, and I tend to start to raise cash, get more defensive during signs of a market downtrend. And signs of a market downtrend always begin by a few bursts of institutional selling. That's one thing. If you look back on the NASDAQ during its recent pullback, I'm only talking 6, 7, 8 days ago, there were several declines in the NASDAQ where volume picked up from the prior session. You weren't seeing above average volume on the NASDAQ, but you were seeing times where volume picked up from the prior session. Little subtle signs like that institutions are selling, which again makes it a difficult environment for all stocks to make headway, but particularly growth and aggressive growth names. Okay, let's see what else we got here. Okay, percent stopping on a losing trade. Again, that's gonna depend. There have been times where I cut a loss at 3 to 4% below my purchase price. Other times I may wait 7, 8, 9% in that area. I would say generally I'm never going to go more than 10% below my purchase price. What IBD type chart pattern have you seen to be the most consistently profitable over the years? There are three major ones that IBD talk about. There's the cup with handle, the double bottom, and then the flat base. I think the flat base. I mean, the cup with handle definitely has a good record of success. They all do, but I really like that flat base. You tend to see the flat base form after a stock breaks out. And then if the general market is still doing well and there's still money coming in, these stocks, breakout stocks, they take a little breather and they move sideways, and they generally won't correct more than 5 or 10% from their recent high. They'll base for about 5, 6, 7 weeks and form a nice little flat base, and then you get another opportunity to get in. So we're almost 3 years. The bull market started in March 2009, so we're a little more than 2 years into a bull market. It's not surprising to kind of see the market choppiness that we've seen this year. So the bull market could still have legs, and if it does, I suspect you're going to see some flat bases form over the next several weeks, especially from some of these stocks that maybe like a Lululemon that broke out recently. Continues to move higher, but I mean, this could be a stock, if the growth story stays intact, you could see it move sideways, form a flat base, and then get another buy point. So I like that tight sideways trading in a chart after price strength. That's typically what you see in the flat base. Question about IBD stock screens. I mean, they're all great inside the paper. On a typical weekend, I'll go through the IBD 50. I may jot down 4 or 5 names, something like that look interesting. Stocks on the move on the homepage of IBD's website, investors.com, showing stocks with moving higher in expanding volume. Another good screen. So I learned to invest through IBD. That's where I started in the stock market. So I have nothing but positive things to say about that paper. It's a great source of stock ideas. All right, folks. If I did not get a chance to get your question, I'm going to throw my email address out there. You can hit me at KenShreve84. That's SHREVE, KenShreve84 at gmail.com. And if you have any additional questions, feel free to shoot me an email, and I will get to it as soon as I can. This is my first webinar for TFNN.com, and I'm sure I will be doing more. Hope you found it helpful, and don't forget, Ultimate Growth Stocks introductory rate is ending at the end of July, and you can get a 2-week free trial, no obligation. Try to take advantage of this offer before the end of the month, though, because the price is going up effective August 1st. I hope you all have a great evening, and let's hope we see a nice day in the market as well. And I appreciate you tuning in. Good night, everybody.